So we got kind of two sections, bond valuation and stock valuation. For stock valuation, we'll just start it. We'll cover dividend discount model, and we'll talk more about other methodologies next class. But bonds we'll cover in good amount of detail. And you've probably seen that. It's kind of very similar to other discounting methodologies we've used, right? You just kind of need to lay out a bond as a series of cash flows. And that's what this problem is asking us to do. So it's not even asking us to calculate the value, it just says, let's kind of dissect the bond. So it says a 5-year bond with a face value of 1,000 has a coupon rate of 9% with semi-annual payments. So 2 payments per year. The first question is, what's the coupon payment? Does anybody want to volunteer that? So take 1,000.
Is it 45?
How much?
45.
Yeah, multiplied by 9%, divided by 2, you get 45. So that's the coupon payment. Thank you. And enter the cash flows. So how many years would we have? If it's a 5-year bond,
Wouldn't it be
well, it's 5 years. Yeah, go ahead.
Wouldn't it be 10?
Yeah, 10 periods. I said how many years? It's 5 years, but it's 10 periods. Yeah, very good. So let's say this is 0, 1, 2, 3, 4, 5, 10. So this is, period 2 is end of year 1. So you get 45 each period, and then 45 year period 9, and then in period 10 you get 45, you get a coupon and the principal 1,000, right? So that's the timeline for a bond. And let's kind of jump. I don't want to dwell too much unless people have questions. I'm sure you've seen videos, and this is just like foundation. And here we'll solve for the value of a bond. Suppose you've got a 7-year, $1,000 bond with 4.93 coupon rate and semi-annual coupons. That's trading at yield to maturity of 3.19. So we have 14 payments, right? Zero, 1, 2, 13, 14. What is the coupon payment? Can anybody suggest that?
24.65.
24.
0.65. Thank you. And that continues every period. And what's the last payment in year 14?
1,024.
Yeah, good. So the other kind of tweak here is we need to convert this yield to maturity into a discount rate, and then we can just apply, the NPV calculation. But what is the discount rate? Because we kind of switch from annual periods to 6-month periods. What do you think the discount rate should be?
Wouldn't it be 1.6?
Yeah, and did you get it by just dividing 319 by 2?
Yep.
Yeah, fairly simple in this case. One 0.595% to be precise. All right. well, number of periods is 14. We've got the interest rate. We've got payments. Can somebody calculate the present value of these cash flows?
Would it be
And we'll compare. Mm-hmm.
109? Wait,
Say it again, 1,000, and then what? I didn't hear.
109 and 5 cents?
1,001. I get 108. Does anybody else get 108, or should we recalculate together?
I got 108.
Okay. Well, let's just kind of check it together. So we've got 24.65 payment. Got future value of 1,000, 14 periods, and 1.595 interest rate. What is the present value? So it's 1,108 and 39. Make sense? In this, so let's kind of rationalize it a little bit. So it is trading at a premium or discount to par.
Premium?
It's a pretty
Premium.
simple question.
Premium.
Premium, yeah. If it's more than 1,000, it's the premium. And the reason it's trading at a premium is that the coupon payment is greater than the yield to maturity, right? So the bond is offering more than investors are demanding as a yield, and therefore, you know, they'll pay more than its par value. What would happen is the yield to maturity rises from 319 to 342. Just intuitively, what do you think will happen to the bond price?
Wouldn't you pay less of a premium?
You pay less of a premium. Good point. And well, let's calculate it. Actually, for me, it's fairly simple. I'll just change the discount rate. But does anybody have the answer for what it would be under 3% yield to maturity?
Wouldn't it be 109, 109, well, 1093.3?
Mm-hmm. Yeah, that's right. So the price went down because the yield went up, right? And again, what we had to do is just plug in. So we had the new yield of 3.42, enter divided by 2, make it the new interest rate, and the present value is 1,093. Any questions here? What I'd like to do next is kind of, you know, explore this dependence between the interest rate or yield to maturity and bond prices, right? So we've just seen that if you raise yield, your price goes down. So we'll kind of build upon that theme and kind of solve this problem here. Suppose you purchase a 30-year treasury bond with 6% annual coupon. So it's not semi-annual, we'll just kind of make it simpler. And then it's a little bit kind of unusual problem here because, I'll have to interpret it for you a little bit. So it says in 10 years time, the bond yield to maturity has risen to 8%. And then, the second point here is if you sell the bond now, what internal rate of return will you have earned on your investment? So at the beginning, when this bond was issued, its yield to maturity was 6%. And then it rose to 8% in year 10. So step number one is to calculate the value of this bond in year 10 with new yield to maturity. And who would guess, like if the yield to maturity increased from 6% to 8%, what would have happened to the bond price?
Decrease, drop value.
It would decrease, right? Yeah, so we need to calculate what that lower bond price is. That will be our step number one. So let's call it value in year 10. And then in step number two, we'll calculate internal rate of return. If you buy the bond at 1,000, you get the coupons and you sell it at this lower price. What rate of return would you earn? So the timeline for this part number one would be starting in year 10 and ending in year 30 with annual payments. So the coupon is 6% of the 60. And then the interest is 8%. What is the value of the bond in year 10? Can someone suggest that or kind of walk me through the calculation? We've done this a couple of times by now. It's kind of nothing too complicated here.
I got 803 and 64 cents.
Yeah, perfect. Thank you. Right. So that's the value in year 10. So let's go to step number 2 here. And this will be between year 0 and year 10. So in year 0, we get, let's say we pay 1,000 for a bond, and then we sell it for 803.64. And then we get coupons. 1, 2, so we just get the coupons, and we also get it in year 10. So the question is, what is IRR? So mechanically, it's a very similar exercise as we just did, right? Instead of plugging in interest rate, we are solving for interest rate when we are given present and future value, as well as payments. So it's kind of same set of buttons, right? Someone want to try that and see what the answer is?
I got 4.39.
Perfect. Yeah. That's the right answer. Are there any questions? Or does anybody want to try that together? Or have any discussion. The IRR is pretty low, right? Because what you're doing, you're buying something at 1,000, selling it at a lower price. Yeah, you're getting $60 in the middle, but it's not a great investment, right? And the point here is the interest rate risk, meaning that it's a secure bond, it's treasury bond, so there's no credit risk. There's no risk that the borrower will default, but there is this kind of market interest rate risk, telling us, like if we buy it now, the interest rates rise in year 10, the price goes down, our rate of return will be impacted by that negatively. So we'll earn a fairly low rate of return on this investment.
Can you explain how you got this 60 in step number 1, please?
Sure. So 60 is very simple. It's $1,000 face value multiplied by 6% annual coupon. And that goes here into the annual payments. But again, annual payments, they continue between year 0 and year 30. It's just in step number 1, we're calculating the value of the remaining payments in year 10 and after. So that's why I drew the timeline starting in year 10, and then basically get the first payment in year 11. And then in the last period, you get 1,060.
Okay.
It may be a little bit messy here, but if you go to this very first page, this is just like a typical timeline of a bond, right? Nothing complex. You get coupon payments, and then you get principal and coupon payments at the end. So that is, the step number 1. And then you take present value of those cash flows.
Great, thank you.
Mm-hmm. Just maybe one more time to practice it. Same problem. It's asking us if instead you hold the bond to maturity, what internal rate of return will you earn on your investment in the bond? So the same bond, year 0, 1, 2, and then 30,000 at the end, 60 is coupon. Would anybody just guess what the
Isn't it 6%? Like
yeah.
the last question?
Go ahead, say it again.
Isn't it just 6%?
Yeah, 6%, right? And the point here is that you do have interest rate risk that we just saw, right? If the interest rates raise in the middle of your holding period, your rate of return will be impacted. But if you wait until the end of the maturity, then you still earn, the initial rate of return. So if you bought the bond at 1,000, you would make 6% return, right? If you just waited until the maturity. And just kind of, since we had this previous question, let's kind of calculate it. So we kind of guessed it would be 6%, right? That makes sense. But so I'll just plug in numbers here just for us to practice one more time. So 60 is my payment. $1,000 would be the future value. And then we buy this bond at also at 1,000. So negative 1,000 is present value. What else? The 30 number of periods. What is the interest rate? I pressed I, and I get 6%. So kind of what to expect. And just kind of same math one more time. Questions, comments? there's a lot of complexity in bond analysis when you get into non-standard bonds. In the recorded lectures, you've heard the term plain vanilla bond, which is what we looked at. But the complexity comes from additional features. They're callable bonds. There are subordinated bonds. Just different features to these instruments, and they require actually a lot of complexity. So basically, in those instruments, you would look at a bond and some type of a derivative instrument, and then those derivatives, they're fairly complex to value. So that's where complexity can come into bond analysis. But plain vanilla bonds are fairly simple to evaluate, and we're not going to get into these complex areas in this course. So I think you've kind of learned all you need for this class from bond valuation. And you expect to have some problems like this on your midterm and final. But again, all that is just the application of discounting formulas, annuity formulas, and things like that. All right, let's go into the next section, kind of second part of the class on stock valuation. And, for now, we will cover a discounted dividend model. So it's fairly simple methodology, and it's basically the same math. What we'll take is, dividends in the future and the expected share price, present value that to calculate the current share price. So let's kind of try this exercise. Suppose a cap corporation will pay a dividend of $275 per share at the end of this year. So let me draw a timeline. There's only two periods. There's now, period 0, and then 1 is end of this year, and 2 is end of the next year. So they'll pay $275 in 1 year, and then $291 dividend $291 per share, and then the next year. And we also expect the stock price to be 5203. If the cost of capital is 10.7%, what is the share price? So once you kind of lay it out on the timeline, it's very simple to what you've had for bonds, right? So we can use a financial calculator. The difference is, though, that for bonds, the payments were the same. Coupon payments, they're contractual payments. For stocks, they're all different. So we can't really use this kind of payment calculation. Let me kind of go back to the basics and kind of suggest, this kind of traditional calculation. So it would be 275 discounted. So for discounting, we just divide by 1.107. So this would be the present value of the first dividend payment. And then the value of the second dividend payment would be 291 plus 5203 divided by 1.107 to the second power, discounted for 2 periods. Does anybody try that? Or maybe you can use your financial calculator as well.
47.36.
47.32.
Yeah, 47.32, right? And the other way, let's try the other way. So on the financial calculator, I haven't used this in a while. I'll clear my records. I'll use this green button, sorry, the blue buttons. So J, and then you see below payment, I have CFJ, which stands for cash flow, and J is number of periods. So, clear one more time. So if I enter 2.75 and then GCFJ, and then second payment is 2.91, enter 52.03 plus. So that's my second payment, 54.94, and then CFJ, that's my second payment. Interest rate is 10.7. Present value would be F and PV. So same numbers we just calculated, 47.32. Any questions? I think it's fairly simple. In the second part, it's the same problem. So the first bullet here is the same. But then the question is, suppose instead you plan to hold the stock for 1 year. What price would you expect to be able to sell a share of ACAP stock in 1 year? Anybody would have suggestions here? How do we approach this problem?
You would do the dividend, the second dividend plus the stock price over 1 plus the cost of capital. So I got 49.63.
How much?
49.63.
Yeah, good, thank you. So 291 plus 5203, discounted by 1 year, is 49.63, right? So that's what you get here in year 1, 49.63. In year 1, you also get another dividend, 275 dividend. Just for fun, if you take that and discount it by 1 more period, what would you get?
The answer we got in the last problem, 47.32.
Yeah, should be getting exactly the same thing. 37. 32. That's if you just discount the sum of 49 and 275 by another 1 period. Good. Any questions? I think we're going very fast, actually. I like how you kind of get this, and any students have questions? No? All right. So we'll continue with stock valuation. And this questions about reinvestment decision. So let's kind of understand the problem. Cupertine Mining has just announced that it will cut its dividend from $4.02 to $2.42 per share, and it will use the extra funds to expand. Before announcement, their dividends were expected to grow at 3% rate, and its share price was $48. But with the new expansion, so they're saving money, they're not paying them out to shareholders. They obviously implement some investments, and they expect to grow at a higher rate. The question is, what share price would you expect after the announcement? So basically, and what implicitly we are asked to analyze is whether this is a good idea to use these funds instead of paying them out to investors. Is it a good idea to keep them, invest into these into this project, and just have a higher growth rate? So let's think about how would we approach it? Like, how would we answer that question? Maybe somebody who hasn't spoken before, if you'd like to give it a try. Let me give you a hint, and I'll just kind of introduce the framework, or the formula, or the concept we'll be using here, and then you'll kind of have to think, well, how do I apply this formula? So the concept that you'll be using here is growing perpetuity formula. So let me write down the formula just to remind you, and pay attention to the signs here. So price in period 0 is equal dividend. Before we had it as cash flow, but now it's dividend in first period. So with growing dividends, it's important to get the right number because it's growing. So it's dividend in year 1 divided by R, discount rate, minus G, growth rate. So that's kind of the concept you'll be applying here. So how would we use it in this case?
First, wouldn't we have to find R?
Yeah, very good. So how do we find it? Let's just kind of arithmetically rearrange the formula so that, how would we calculate R? So what's the formula for R?
If you take the dividend over your price and then do that, then you add your growth.
Perfect. And let's plug in the numbers. And this would be under old scenario, right? Sorry. Dividend.
Oh.
Yeah, go ahead.
4.02 over 48.89 plus 3.10%.
Mm-hmm.
And you would get 11.32%.
11. And let me just do that. I think it's right, but let me just recalculate. So yeah, 402 divided by 48.89 plus 3.1. I get 11.3. Is that what you said?
Yeah, 11.3.
Okay. Let's do one more time. 402 divided by 4889. Okay. And then for the second part, to calculate the new share price, we will just go back to the original formula, right?
Yeah. And
Well, you know what? Sorry, just one more thing, because I was getting different answer compared to my, my solution actually had, like one more tweak here, and this is what I was reminding ourselves about. We need to multiply this dividend, which is, see, like if you read it carefully, it says, it'll cut a dividend from 402, but in the formula, it's asking us to use dividend next year. And next year, with the old growth rate, we should be using, 402 times 1 plus 0.31. Basically, increase the dividend by another 3%. Let me recalculate that. So it'll be 11, but it'll be a little bit different.
Is it 1108?
11, I get 58. Does that sound right? Did people get the same number?
What was your
1158?
number? What was your answer?
What's that?
What was your answer?
1158, 11%, 11.58%.
But I got, that's it.
Okay, good. So basically, we just have to grow the dividend to the next period. And then when we apply it in the second part, so we'll be doing P0, right? Let's be careful to use expected dividend next year. So the new dividend today, as if it was today, is 2.42. But then we have to grow it by 1 plus 0.052. And for this part, there's a little bit, again, like, just be clear in the formula. The formula for sure is asking you to use next year's cash flow, right? So there has to be this gap between present value and the dividend or the cash flow that you're using in this perpetuity formula. Now, the problem can be phrased a little bit ambiguous here, right? Because when they're saying here, it'll cut its dividend to 2.42, kind of doesn't say whether it's going to be like this year or next year, right? So you could interpret it, maybe that's the next year's dividend, but you have to clarify it. So like I take it as, if they were to pay out this new dividend today, it would be 2.42, and that's why you would increase it. But again, like see how the problem is phrased. And then, so you would take a discount rate, which hasn't changed. Well, we just calculated in part 1. So it's 1158 minus the new growth rate.
$39.92.
Yeah, perfect. 39.92. think in your textbook, this problem is from your textbook, and somebody pointed out to me, I think the solution in the second part, they may not apply this kind of this part here, which again kind of implies that the way this would be stated is this 2.42 would be next year's dividend, right? But again, you just have to read carefully and interpret that correctly. So if this was 2.42 today, then to use the formula, you would grow it by another 5.2%. Any questions?
I can't pull up the assignment that we had, but this was exactly like question 15. And in the MyLab, we didn't do the like adding it another year. So
Right.
so I guess
That's what I'm saying. And somebody pointed that out to me as well. But again, if you don't grow it, then you are interpreting this new dividend as dividend happening next year. Just be clear on that.
but will that be explicit on like an exam?
Yeah, I'll make sure it's
Okay.
stated clearly, right? But kind of how do you interpret the problem? Again, what you need to be absolutely clear on is this formula I have up front, right? So there's clearly a 1 year gap between the value that you're getting and the cash flow you're using in your nominator, right? So there's no doubt about that. Any other questions, problems? All right, let's go to the next problem here. Visa has just paid an annual dividend of $1.31. Visa's dividends will grow by 6% in the next 4 years, and then grow by 1%. Let me draw that. 1, 2, 3, 4. 1, 2, 3, 4, plus 5. So let's kind of calculate the payments, because there are multiple stages and we have to calculate these individual payments. So they've just paid $131. So what would they pay next year if it grows at 6%?
139.
138.
Yeah, 131 times 106, and that is 1.38, and I think 86. And then you would do the same thing every year. We kind of have to do it because you have to get to the final year, year 5, right? To kind of then use perpetuity formula. So what's the second cash flow? Just keep multiplying, the previous year by 1.06. Get 1.4719. I just multiplied the 106 again in the second period. How about the third one?
I got 1.56.
Mm-hmm. Good. 1.56 and 0.23. I'll be precise here because we'll have to use these numbers. And remember, good rule is don't round numbers too much in your interim steps. So that's cash flow number 3. What's cash flow number 4? Just grow it by another 6%.
1.65.
1.65. Now thinking about 384. Okay. So, and then we switch into different growth rate. So in year 5, the cash flows will grow by 1%. How do we capture those remaining cash flows? Well, it's growing perpetuity formula that we just did, right? So what would be the components?
Would it be 165.37, just the 165 divided by the 1%?
What was your answer? Well, so 1% is the growth rate. You have to discount. Remember, in the growing perpetuity formula, you had in the numerator, you had next year's dividend, right? So what's our next year's dividend? Dividend in year 5.
It's
What would that be? 1.65384 times 101. Oh, let me free up some space here. So 1.65, I'll kind of round it here, but times 1.01. So that's the dividend in year 5, right? Growing at 1%. And then what does the perpetuity formula say? You divide next year's dividend by discount rate minus the growth rate. So what are these numbers? Required rate is 7%, right? Minus growth rate, 0.1. What is that value?
$23.85.
23.85. I got something else. Let me just do it in the calculator. Because whenever we get differences, I like to do it together.
27.
So my my starting point was 1.65. That's year 4 dividend, right? 384. 1.65384. Enter. And then I grow it by 1%. That's my numerator. And then in denominator, I get 0.07, enter, 0.1 minus, and then I press divide. So you get 2783 900 183.96. And how do we interpret it? Like, what did we just calculate by using the perpetuity formula?
The cash flows from year 5 forward, the value of the cash flows from year 5 forward.
Yeah, very good. So I'll put it on a timeline. So 27 went 8397. So you can say I've got 4 cash flows, right? This was 1, so 1.38 is 1, 1.472, 1.563, and then in year 4, you get 2 cash flows. Again, kind of the math now is kind of like what we had in the bond, right? You had cash flows, except that they're variable here. And then in the final period, you've got dividend payment and the share, the value of the remaining payments. Now we just need to calculate the present value of this. Can somebody try it or maybe walk us through? If you get a different result, I'll kind of do it together, but somebody maybe just kind of volunteer and give it a try.
I got 2767.
I get a little bit different number. I get closer to 26. Anybody else? Got a different number? Any other data points out there? Well, let's just do it together. What's our first cash flow? I think you may be doing it in Excel. I'll do it in the calculator. What's our first dividend? Can somebody, because it's just easier for me if you tell me
It's
what it is. And I'll
131.
plug it in. 1 point. Well, it's 1.31, but then you have to grow it, right, by 6%.
1.3886.
So yeah, I'll just multiply the 106. So 1.31 106 multiply it. So 1.3886 is my cash flow 1, first dividend. What's the second dividend?
$1.4719.
4719. Yep. Cash flow 2. Third one?
1.56023.
Yep. Third one, and the fourth, that one has 2 components. What's my fourth payment?
The fourth payment is 2949.
2949. Yep. And what's the other 2 decimals there?
36.
Okay. So that's GCFJ And then our interest rate is 7%. We'll press F and P. So we get $26.3575. $26.35. So that's the answer to this problem. Does anybody else get different numbers or have any questions? Okay, well, let's do, this is my last problem, and then we'll talk a little bit about other valuation methodologies. This one is actually very similar to the one we just did. Apple paid quarterly dividend of 3.87, and dividends are expected to grow by 10% for the next 4 quarters, and then by 1.4% thereafter. So, and this is quarterly, so we'll need to make sure that we're using quarterly discount rates. Otherwise, it's very similar to what we just did. 1, 2, 3, 4, 5. So I'll just think about them as periods. So we'll have to calculate again these, the dividends in each period, so that we can kind of wrap all other payments in this growing perpetuity formula, right? So let's kind of just go through a similar exercise as we just did. So maybe if somebody wants to start, multiply these dividends by the growth rate, 10%, and then just maybe tell me what they are. So start with 3 to 7 times 1.1. What is that?
4.257, so 4.26.
4.257. Let's keep them pretty precise. We don't want to round them yet. And then kind of keep growing that by 10%. What do you get in year 2 or quarter 2?
4.6827.
4.6827. What's the next one?
5.15097.
5.160.
Oh, 5.
How much?
Oh, I got 5.15097.
Just check that. So it's 4.6827 times 1.1. Yeah. That's all right. Yep. And the fourth one?
5.6660.
Mm-hmm. So kind of same idea. So now we need to apply the perpetuity formula and then grow this 5666 by the new growth rate, right, which is 1.14, so 1.4%. And what's in the denominator? It should be discount rate minus the growth rate. So required quarterly return, 3% is the discount rate. 0.3 minus 0.14. Should be a pretty large number.
359,087.
Mm-hmm. Yep. Yeah, and kind of the interesting thing is, you know, as the denominator gets closer to zero, you start getting very high numbers. So the dividends are not that big. You know, we got $3 per quarter, and that our kind of perpetuity value is 300, right? That's just a function of having very small number in denominator. So don't be surprised by that. But you know, it's almost like grows exponentially as your denominator gets closer to zero. So the final cash flow would be, you know, 5.6 plus 359. So let's just kind of punch it in and then see what NPV we get. I'll let you work through it and tell me, like, if you got any differences, we can just do it together. But why don't you try it and, you know, give me a couple answers for the NPV. Any volunteers for NPV calculation? And by the way, how are you doing it? Are you doing it in Excel or calculator? What's easiest for you?
Excel is easiest for me.
Mm-hmm.
I think for me
Yeah,
also,
right.
it's in Excel.
Me too.
Especially when dealing with multiple payments or cash flows
Right.
over different periods.
I agree. When you start getting into more complex calculations, Excel is easier. But you know, for annuities, for example, calculator is nice. And it's also kind of good to be able to use it just in meetings, you know, somewhere where you don't have a computer in front of you. I think it looks pretty impressive if you can just punch it in and get quick answer. So what do we have for NPV here?
I got 337 and 34 cents.
Perfect. That's the right answer. 337 and 34. All right. So this is all I had for problems. We've got another 15 minutes. Let me kind of start talking about what we'll be doing in next class and kind of set the ground. We went fairly quickly through these problems. So I'll just kind of get us started basically on the material of the next class. Let me add another page here so that I can write on it. All right. So let's think about stock valuation. Has anybody dealt with it before? You know, it's kind of, as I mentioned, fascinating topic. Maybe even like for your just personal interest, you know, your personal investments. I'm sure you know people have a view kind of how to do stock valuations. Yeah, and you probably have listened to the videos by now, so you know kind of what the right academic answer is. But what are the main valuation methodologies that you've heard?
The next
So
two that we,
discounted dividends. Yeah, go ahead, Ashley.
I was just going to say the next two that we didn't cover from, I think chapter 9 were free cash flow and then multiples.
Yes, perfect. And let's talk about free cash flow. I just want to give us a preview on that. So FCF, and then the other big one is multiples. Here. So for FCF, just as a preview, what you need to know is obviously a free cash flow formula. And I'll kind of write it for you. It's got 4 components. The first one, I guess we can call it EBIT. EBIT. And then I'll kind of give you the textbook version. There's also, I use kind of a little bit different version, but it's kind of results in the same number. So it's EBIT multiplied by 1 minus tax rate. And tax rate, you have to be a little bit careful here because it is unlevered tax rate. So if you go to financial statements or you have your income statements, for example, and you see taxes there, for free cash flow purposes, you kind of run this calculation. You don't want to just take your taxes from your income statement. Basically, it's EBIT times 1 minus the tax rate, and then you subtract CapEx, capital expenditures. You add back depreciation. And it could be plus or minus change in working capital. Let's talk about these components. Where would we typically find them? Let's say start with EBIT. Where would you find EBIT for a company? And I'm thinking about financial statements. So let's say you've opened up their income statement and balance sheet and cash flow statement. Would you see EBIT there, earnings before interest and taxes?
Not exactly, but you can calculate it.
Go ahead. I think you're breaking up a little bit.
So it is not like in a specific line, but you can calculate it fairly easy with the income statement.
Right. Yeah, EBIT is actually fairly simple. Sometimes, the companies may call it something a little bit different, like operating profit, or sometimes they call it earnings before interest and taxes. But that one is actually kind of, you may have to calculate it, but sometimes you can just find it on the income statement. That one is actually fairly simple. And then you have to take it after tax. So you multiply it by 1 minus the tax rate. And tax rate, sometimes you have to calculate because, how do you know what the right tax rate is for a company? So quite often what you have to do is calculate what's called effective tax rate. So you would look at the taxes that the company has paid and then divide the taxes that they paid by pre-tax income to calculate what the tax rate is. So that's where you would find the tax rate. And then the next component here is CapEx. Where would you find CapEx?
In the cash flow statement.
Good. Yeah, cash flow statement. Usually it's a negative number. Cash outflows are negative, so you take it as negative. How about depreciation? That one can be a little bit tricky.
Cash flow statement as well.
Yeah, go ahead.
In the cash flow statement is the second.
Yeah, you can usually find it on the cash flow statement. So what happens, it's included in your cost of goods sold, it's included in costs on the income statement, but it's usually not shown separately on the income statement. So it's an income statement category, but it's not broken out usually on the income statement. Companies have to show it on cash flow statement because it is one of the adjustments that you would make when you get from net income to cash flows, right? Depreciation doesn't require any cash outflow. It's just an accounting entry to account for the capital that you've used in your business. When companies show adjustments from net income to cash flow, that's where you usually find it. So yeah, that's the right answer. You find it on the cash flow statement. And then the last one is a little bit tricky, change in working capital. So we have to be familiar with the working capital concept. Do people know what that is? Does anybody want to volunteer what the working capital is?
Current assets minus current liabilities from the balance sheet.
Right. Yeah. So it's fairly simple, and typically you do not. So when you look at the current assets, you typically don't include cash in your current assets, but everything kind of after cash, you would have accounts receivables, inventory on your asset side, and then accounts payables on the liability side, right? So you would subtract current liabilities from current assets, and that'll give you 1 point in time. So when you just subtract it, it still is kind of a balance sheet item, right? It will tell you company had $100 million working capital as of, let's say, December 31st. So for cash flow purposes, you have to calculate the difference. And what it means is basically investment into working capital. So CapEx is investment into fixed assets, and change in working capital is investment into short-term assets. So basically, let's say typically when the company grows, its working capital also grows. So let's say if in 1 year you had $100 in working capital, and then a year later you had $110 in working capital, then that change is $10. And that $10 what goes into your cash flow. So it's just the change in those net working capital. All right, so it's actually fairly straightforward. I think this free cash flow formula is quite important for valuation. We'll kind of go through that next class. We'll calculate free cash flows. Another kind of important topic is I think we'll cover it in later classes is what do you discount free cash flows by. So in the next few classes, we'll talk about weighted average cost of capital. But just as a preview, weighted average cost of capital is the average between cost of debt and cost of equity. So that's what you use to discount free cash flows. And this kind of maybe lastly before you wrap up, I like how we talked about the second methodology, multiples. Do people know kind of any popular multiples? You know, what multiples have you used in the past, or have you seen?
Real estate comps.
Is it the real estate comps?
Comps and real estate. I think that's what it compared it to in the notes.
Okay, but you know, can you give me an example of a multiple that that you've heard of?
Oh, I see.
Multiples usually it's like one number divided by another number. So like give me kind of those examples. Like, you know, if you've seen it in real estate, you know, maybe use one from there, or has anybody heard any common multiples?
Like a PE multiple?
Yeah, exactly. That's a very traditional multiple, price divided by earnings. And usually what it means is it could be either market capitalization divided by net income, or it could be EPS, which is reported earnings per share. Sorry, it could be reverse that, or it could be share price, or it could be share price divided by EPS. And what you do, if you divide market capitalization by number of shares in the company, you get to share price. And then if you divide net income by number of shares in the company, you get EPS. So that's why these formulas are equivalent. Another kind of very popular multiple is called EV to EBITDA, enterprise value to earnings before interest, taxes, and depreciation. And I'm not going to get into it now, but we'll cover it in the next class, kind of what the difference between market cap and enterprise value is. It's basically net debt, but we'll cover it in the next class. The idea behind multiple methodology, it's kind of relative valuation methodology. So let's say you have a company that you're trying to value, right? And you know that their earnings, so in this and you're trying to apply P ratio. Let's say you know that this company's earnings per share, EPS, is, let's say, $10. So the way you would apply multiples methodology, you would look at how comparable companies are trading. So let's say you have Apple, and Apple is like, let's say they have EPS of 10, and then you would see like, what are the comparable companies, what are they trading at? So what's their P ratio? And you would look at, I don't know, Samsung or Google, like those high-tech companies. And for example, and you would kind of go through, you would calculate P ratios for them, and then you would take some kind of average, and you would say, okay, so the P ratio that should apply to Apple, let's say, well, it's usually pretty high. I don't know, let's say like 30 times. So, and you would calculate that P ratio based on comparable companies, not on Apple. So you look at other companies. And then to calculate the share price, you would multiply $10 by 30, and you'll say, Apple's share price should be 300. So that's how you would apply it. Kind of similar idea. Let's say you were buying a house, and you've got houses of different sizes, but you're trying to look at comparable houses in your neighborhood, but they still could be different size. So the multiple you can use, we talked about real estate. Let's say it's price per square foot. So you would say, my house is 200 square feet, and the average multiple dollars per square foot, let's say, is 200, and then it should be 400,000, right? Something like that. All right. Well, I think I'm a minute over our end time. So I just gave you a preview of these other stock valuation methodologies. You know, as you kind of dig deeper into that, you get a lot of different approaches, a lot of assumptions that can go into that. So that's what makes it, you know, fairly complex and exciting.